Hello friends, myself Sambhav Gupta. I am just preparing this video on the request of the students about this solution on this question, sorry, of the May 2026 paper question on the CFI, the compounded financial instrument. So here a lot of things are there, which is hidden in this question. So that means you should have the understanding about the background of all these things, so that it will be easy for you to ex- under to solve this question. And maybe in the future the student, if the institute they tweak this question, so at least you should understand at high level that this is the thing which the institute has, they have done the tweak, correct. So coming back to the question, so this quickly I'm just reading it. So this is the question of the CFI, the compounded financial instrument. The Power Tech Limited issued 50,000 5-year 6% convertible debentures on 1st April 2023. The debenture have a face value of 100 each. The term of the debentures are as follows. The total face value 50 lakh. The coupon rate is 6%, which is payable annually on the 31st March. March. The conversion option. So I'm writing it here also. So this conversion option. So this is very common here. You have seen all these things, the conversion option. So at the maturity date 31st March 2028, the debenture holder has the option to convert the debenture into 10 equity shares of Power Tech Limited per debenture. So this is here, it's a equity instrument, because here this F to F, the fixed to fixed test is passed, because here you are having the 10 equity shares you are getting for each debenture. And and I hope, if you want in detail about all these things, so then you can refer to my video on the CFI, the compounded financial instrument, where I've explained the concept, and plus I have referred the institute module where I've explained line by line that material. So this is the conversion option, then the prepayment option, the put option, correct? So here this, if you refer, so just I'm referring it quickly here. So it's a equity embedded derivatives. Why? Because you're getting the equity here, the holder, and here the prepayment option, the put option. So that you should understand about the put option. Put option means the holder is having a right to surrender this debenture, and against it it will be getting the cash here, because here they mention the cash. The debenture holder has a right to demand early repayment of the debenture at the end of the third year, that is the 31st March 2026. The prepayment amount will be at a premium of the 5% on the face value. So 5% of the face value, so that means it is coming 52 lakh 52 52 lakh 50,000. Okay. So 52 lakh 50,000, the 5% premium. So this is the thing. So if the holder, if it exercises this prepayment option, so then the life of the instrument, it will be 3 years. Correct. And if it doesn't exercise, then the life of the instrument will be the 5 years. Okay. So, and here the market interest rate, so that is your effective interest rate, that is a discount rate. The effective market interest rate for the similar non-convertible debenture is 10% per annum. So this is a very tricky statement. You should understand about it. And quickly, just I will tell you here. So like here, if you see, I have made the picture also. So this is a CFI instrument, the compounded financial instrument, where you are having a plain vanilla debt. So just I am writing it with the short form, the P, plain vanilla debt, plus the embedded derivatives. You are having a two embedded derivatives, non-equity and the equity. So the non-equity is your prepayment. This one, the prepayment option, that is a put option, because non-equity, because here you are getting the cash, the holder, and the equity embedded derivatives, because here you are getting the fixed number of the equity. So here the two types of the embedded derivatives are there. So please refer to my previous video of the CFI. From there, from in it, I have explained in a very detailed manner. Okay. So now here this market interest rate, it is the effective market risk interest rate of the non-convertible debenture. This non-convertible is also very important. So non-convertible means your plain vanilla debt and the non-equity embedded derivatives. So non-convertible, correct? So this plain vanilla debt plus non-equity derivative is, we call it as the hybrid instrument. So I've written it as a hybrid instrument as a short form hybrid instrument. So in the hybrid instrument, you're having a plain vanilla debt plus the embedded derivative. So hybrid instrument is a host contract plus the embedded derivative here. So here the catch, the one point. So here the three different points are there in this one, which are hidden. So whether to split this embedded derivative, that is a non-equity embedded derivative or not. So that also you need to decide it. So here the institute they have presumed that okay, for the first thing, for the splitting the non-embedded derivative, non-equity embedded derivative, you need to satisfy the three conditions. That is a non-closely related, the accounting of the host contract and the embedded derivative are different, and the embedded derivatives they are separately tradable, separately available in the market. Okay, and so these are the three conditions. If the three conditions are all three are satisfied, then only you need to split the embedded derivative from the host contract. Okay. So in this hybrid instrument, the host contract is your plain vanilla debt, and the embedded derivative is a non-equity. That is a prepayment option. That is a put option. Okay. So here they have given the 10% interest. So it is of the hybrid. So simply the institute they have presumed that it is a sorry, it's a closely related. That's why they have given the effective interest rate of the hybrid instrument. So in the non-closely, various things are there. From there, you can determine whether the embedded derivative is closely related to the host contract. This is the most tricky point here in this splitting of the embedded derivative. So in that, the one point is if the amortized cost is equal to your exercise price of the option. So that means here the exercise price is your this one 52 to like 50,000. If your amortized cost is similar to your exercise price, so then it is a closely related. So this is what institute has presumed here. So that's why they haven't split the host contract and the embedded derivative here. Okay. So this is the one presumption which is hidden here. Um Second thing, now in this one the 10%. So and here the institute they should have given that whether this put option is how much it is probable that is it likely that this option will be exercised or not. So from this we can interpret that this put option is highly probable that it will be uh, exercisable. Why? Because here the AIR is 10% and your coupon is 6%. So 10% it is more than your 6%. So that's why it is in the money. So this prepayment option is in the money. So it will be exercisable. So that's why the the maturity of this hybrid instrument is 3 years. So 1st April 2023 to 31st March 2026, it is coming 3 years. Okay. And in the conversion option, it is coming 5 years. That is of 23 to 28, it is coming 5 years. So at the inception, this prepayment option is in the money, which is hidden. So that's why your instrument life is 3 years, not the 5 years. So three things are there in this one. This embedded derivative is closely related. Second thing, this 10% it is of the hybrid instrument, not of the plain vanilla debt. And third thing, the maturity, the time period, it is the 3 years. So this is very important point, which the normally the students they skip, and I think even in the class also they haven't explained so much in the detail about it. So that's why this question becomes very special. Like, but from here also you can explore lot of things. Like if the institute they tweak instead of this non-convertible debenture, if they mention the plain vanilla debt debenture, interest is 10%. So then you need to find out whether whether the embedded derivatives to be split or not. So those things will be there. So here the institute they have simplified that the embedded derivative there is no need to split it because it's closely related. So all those things you need to understand. Okay. So I think this is the main what I need to explain. Now it is very straightforward. So first point is the analyze the nature of the instrument. So it's a compounded financial instrument because here you are having equity uh, embedded derivative. That is your conversion option because it is satisfying the fixed for fixed test. Now the compute the value of the liability component. So here I've already done it, but in my running writing, but I will explain it to you. So the CFI is your hybrid instrument and plus the equity embedded conversion option. And in the hybrid instrument, you are having a plain vanilla debt plus your prepayment option, that is your put option. So, and this is your equity embedded derivative, that is your conversion option. So the um, so here the hybrid instrument life is the 5 years. So we need to calculate the hybrid instrument present value. Quickly, just I will. So here this I've done it. So this is in the number line. So this is of the 3 years. So this I've explained why it is a 3 years. So this is we are standing at the inception, first year, second year, and third year. At the end of the third year. So here the interest you will be getting the 3 lakh. 3 lakh means why? Because 50 lakh into the 6%, it is coming 3 lakh per annum. So this is a 3 lakh, 3 lakh, 3 lakh, 3 lakh, and at the redemption you will be getting to the 52 lakh 50,000. That is a 50 lakh plus for the 5% the premium amount. And if you discount it at here at the effective rate of the 10%, so then it will be coming 46 lakh 90,395. So that is a 3 lakh into annuity factor, this one 2.4, and 52 lakh 50,000 into 0.7513. So it is coming 46 lakh 9395. So this is the value of the hybrid instrument, and the CFI value is 50 lakh. In this question, it is silent. What is the issue price? So we presume that the face value is equal to your issue price, 50 lakh. So now 50 lakh minus 46 lakh 90,395. The difference it is coming. Sorry, 3 lakh 9,006. Yeah, 3 lakh 9,605 is your residual value. This is of the equity embedded derivative, which is straightforward. Correct. So this is the value, and the accounting entry will be bank account to financial liability to equity. Bank account will be a 50 lakh. Financial liability will be a 46 lakh. This one, this amount, and the equity will be a 3 lakh. This amount. Okay. Now coming to the third point, so assume the debenture holder exercises the prepayment option on 31st March 2026, pass the necessary journal entry to record the derecognition of the financial liability and the treatment of the equity component, show you're working for any gain or loss. So here there will be no gain or loss because uh, at the maturity your amortized cost will be this much, 52 lakh 50,000. Why this I will show you, but if you see the number line, so this amount 46 like 90,000, you are arriving it from this one, correct? So this amount you are taking and then you're discounting at the 10%. So and now uh, from this 46 like 90,000 you are going to this amount. So obvious, and that is also at the 10%. So it will be your the amount will be your 52 lakh 50,000. So it is like a circular. First you are going from here to here, and now for the third point you are coming from here to here. So obviously it will be your this amount will be there. So this I will show you. So this is just a mechanical thing, but yeah, at the end there will be no gain or loss. So amortized cost is equal to your exercise price. So that is also another thing which we have proved here, that amortized cost is equal to exercise price. That means your embedded derivatives, that is a non equity embedded derivatives, the prepayment option is closely related. So that's why you haven't split it. Okay. And for the equity, it will remain in the equity only. This is also very straightforward, but in that also you will be just changing the line if you want to do the changes. So only coming to the financial liability you will be, means you are following the amortized cost, so that means it will get revalued every year, and this is also you have done it. So, but yeah, just I will just show you quickly how we have reached to the 52 lakh 50,000. So this is the opening balance, this one, then 10% on this one, then the coupon is minus 3 lakh, and the closing balance is this much. Now this will become your opening balance at the second year beginning, then again 10% interest on this one, then 3 lakh minus coupon you will be deducting, and then you will be coming 50 lakh this much amount 45,000. Then at the third year again the 10% on this much, then minus 3 lakh, it is coming this amount which is equal to your equivalent to your 52 lakh 50,000. So this is what I hope you like this video. If you like this video, please subscribe it and circulate it among your friends so that they should also have this knowledge about it. So here the lot of hidden things are there, which is the main thing which you understand about it. Yep. Okay. Thank you. Thanks a lot.